Abimbola, who is one of the investment analysts at Afrinvest, to put the first half in perspectives for us and give us some window into the second half of the year. Good morning. Thanks for coming.
Good morning, Boston.
Very interesting time, isn't it? 2.2 trillion from the equity side. That's quite a lot of money by today's exchange rate standard, isn't it?
Indeed, a lot of money. And like you mentioned earlier, the equities market was very, very active in H1 2017, thanks to three factors. Number one, we saw earnings rebound significantly for companies in the banking and industrial goods space, propelled by the improving economic fundamentals of the country, as well as the different specific factor drivers for these companies. So earnings rebounded significantly in Q1. When we looked at the NSE 30 index, we found out that earnings for companies in the index increased by 65% year-on-year in Q1 2017. So earnings were good, and then we saw the actions by the central bank, particularly in April, when they opened the investors and exporters window. So that has led to improvements in confidence by foreign portfolio investors to the Nigerian markets. So we've seen inflows, trickling back into the market, and valuation multiples for the companies in the NSE in the stock exchange, it's been going back to pre-crisis level. For instance, if you take a stock like GT Bank, for instance, before the higher new window was opened, the valuation multiple was around 1.3, 1.5 times price to book. But look at it today, it's not trading at 2.1, 2.2 times price to book. So that shows that investors are now, correcting for the undervaluation of equities that we had in the past, which was mainly distorted by the FX pricing, policy of the central bank.
I like the market fundamentals and the technical analysis around it, whether it is FX and holding interest rates on change and inflation, base forming a little bit there, even though it's the base effect. But look, let's take a bit of a wider look very quickly at the market. You've seen the PMI numbers. We just read them out. You saw the one for the month of May. You saw the month of April. Does it look like in the first 6 months of the year, the fiscal side, the economic side of things, are beginning to rev up a little bit, giving some support for investors, local and foreign, who says, hold on a second, I think Nigeria is a place to still put in some portfolio investments?
Right. Nigeria became open for business again in April, thanks to the FX policies of the central bank. But then again, if you look at the broad macroeconomic indicators, the whole points to a recovery, being in the offing. The PMI readings, for instance, since April, we have seen expansion in both manufacturing and non-manufacturing, PMI indicator, which show that activities, they are picking up in respective sectors of the economy. If you look at the FX markets as well, most industrialists are now reporting that they have a very short, time lag between demanding for FX and getting the supply from their dealers, from their banks. So with FX availability improving, rates improvements in the parallel markets, the cost structure of companies, particularly in the consumer goods and industrial goods space, it has become a lot more reduced, and that will have a fundamental impacts on their earnings going forward as well. So
I like the going forward.
Correct.
So what do we go from here in terms of outlook for the second half?
We expect for equities markets, we think that gains are a bit more capped. The upsides are now very thin compared to 3 or 4 months back. We had a very strong rally in H1. We shouldn't expect the same thing in H2 again, because if you look at valuation multiples today, they are now very close to pre-crisis level. So we see probably between a 5% to 10% gain further in the year. But the fixed income market should be the much more interesting market to look at for in H2. In the past one and a half years, 1.5 and 6 months, the central bank has been tightening monetary policy aggressively by increasing Omo clearing rates, forcing T-bill rates upward. But if you look at the results of primary market auctions for treasury bills and bonds in the past 2 months, you will see that traders are now expecting a cut in interest rates going forward, because they are now positioning in longer duration, bonds. Take for instance the last DMO bond auction that held in June. There was under-subscription for the shorter tenured instruments. For the longer tenured bonds, you are seeing a lot of subscription for it, which shows that traders are now trying to take a long duration position in anticipation of a drop in interest rates. Thanks to the decline in year-on-year inflation rates, improvement in FX liquidity, central bank now has much more scope to his monetary policy going forward.
That
should be an highlight.
That's something that I'm sure you're keeping an eye on the next MPC
Correct.
meeting. I'm doing so. Thank you very much for coming.
My pleasure.
Omotola Abimbola, an investment analyst from Afrinvest, and we're sticking with the markets and talking into the SEC.